Hi, this is the Intentional Wealth Update for the week of January 17th, 2022. I'm Dennis Morton here with Katie Brown. Katie, how are you?
Hey, Dennis. Great. How are you?
Good. So we're starting off the year with a little bit of a rocky returns in the stock market and the bond market. We want to talk a little bit today about volatility. We might even mention those four most dangerous words in investing. This time is different. We're going to talk about just why things are unique, at least right now, and how we should be thinking about the opportunities and risks that exist when volatility comes back yet again. So, Katie, tell us about the conditions that are existing here. We're a couple of weeks into the new year. What's happening in the stock and bond markets?
It's interesting. We're seeing volatility both on the stock side and the bond side. This is kind of an interesting time. We've had such a smooth run for the most part with stocks. I mean, we had, a 5% pullback one time last year. That was about it. And we hit a lot of new highs. So it's been a pretty smooth ride up. And I think that it's starting to make some investors a bit cautious for what may be down the road. And so we're starting to see some changes in where people are investing their money, pulling back from some of those high flyer tech stocks maybe and shifting more to like things like financial and value. So we're seeing some movement and we're seeing the US stocks pulling back this year down about 4.5% versus international stocks down only a little over 1% for the most part. And so a little bit of a change. Once again, US has been the leader for a while. But then on the bond side, it's also an interesting time with inflation concerns. We're starting to see the impact of some of the Fed moves on the bonds. I don't know if, Dennis, you want to kind of talk through some of the impact on the fixed income side as well.
Sure. Yeah. I mean, we've had a rapid spike up. We're up over, we use the 10-year treasury rate as a measure of safe money. And it's gone up to about 1.8, 1.9% in that ballpark. And that rise really puts a lot of downward pressure on the price of bonds, especially longer term bonds. So for those who've been impatient, waiting in short term or really stable bonds and kind of taking some more risk to reach for yield, that can have a lot of impact, especially as rates rise quickly. One of the things I think is interesting, Katie, I almost think this should be a little bit of a relief to certain investors, because we talk to people sometimes and they've been really skeptical about the market where it was over the last 10, 12 months. I don't buy in this. It all feels very manipulated. Everything seems so expensive. But then you look at the NASDAQ 100 and you see just the number of stocks that are down 10 or 20% in that index. If you thought it was too expensive then, you might start feeling a little bit heartened that the risk is getting wrung out a little bit, and some of the companies with either lower quality or no earnings are being kind of outperformed by companies with higher earnings. You're seeing the value side. We've talked before about the difference between value and growth investing. So if you're looking at something like Procter & Gamble or banks or some of the consumer names like Coca-Cola, look at the S&P 500 value side, and its outperformance has been pretty stark so far this year, over about 6% over the growth side. So those are heartening things. And we've talked about this before. It's not the market. There are different slices to it. There are different ways to parse it, and making sure you're not overexposed to any one of those can be a good balance right now. We talk about, is this time different? I don't know. It's probably unique. So, Katie, what are some of the things that you think make this year particularly different for investors, where they're not getting too hung up on what happened before?
Yeah. Well, I think it is, once again, going back to the stocks versus bonds, because oftentimes, we think about them moving in opposite directions at opposite times. And they have the potential now to both sides wring out some of that risk. Staying higher quality may pay out in the long run, but in the short term, it is, a lot of that risk is being wrung out. And so I think that makes it a little bit unique. I think we're still dealing with some challenges, whether it's labor shortages, supply chain issues. Consumers still want to spend money. We're still seeing the impact of a lot of the stimulus that was pumped into the economy last year. Consumers are still anxious to spend money, but on the supply side, there's still a little bit of a churn there. And so I feel like there's some kind of competing powers that are going on, which are still part of the aftermath of this pandemic.
Yeah. And that tension isn't always a bad thing. There's a phrase, the markets like to climb a wall of worry, right? Mm-hmm. And think back, 18 months ago to the summer of 2020, when the pandemic was still relatively new and the market had bounced off of its bottom. And despite all of the continuous bad news, was going up at a pretty fierce pace. It was climbing a wall of worry because that tension actually has investors seeing opportunity. And I think that's where we need to say, like, there needs to be that tension coming back. What was getting wrung out was the lack of tension that we saw a year ago. If you flash back to January and February of 2021, this was one of the oddest periods of the market when you had the Reddit traders, the meme stocks, cryptocurrency, you name it, the ARC platform, just money was just flooding into that, and it didn't make a lot of sense. And a lot of those stocks are down 60, 70, 80% now. So we kind of needed to get rid of some of the irrational exuberance, to coin a phrase, right, to get there. What do you make of January of 22 versus 21?
Oh, I have to say, and I'm going to mention this first. Anybody that got caught in that and that lost real dollars, real money, really impacted their lives. I feel horrible for them because I think it was an easy trap for a lot of people to get caught in.
Yeah.
That being said, I am so happy that that those are not the headlines each day right now.
Right.
I mean, for a while there, every single day, there was some sort of stock that was being inflated from social media, and people were diving in and talking about how much money they were making. And unfortunately, I think for the general public, there wasn't enough awareness around the risks. And so I am grateful that doesn't seem to be, we're not seeing that level of exuberance now. Some of this volatility that we have feels like the normal shaking out of risk. It's kind of normal market behavior that we need on occasion, because a year ago, just once again, kind of following some of the headlines and seeing what was happening with some of those stocks that just had no real value behind them, companies that had no real value. That's a scary environment to stay in.
So what has you concerned this year, this time? Is there anything in general that has you just on your heels a little bit?
Yeah, I am concerned for the conservative investor. Bonds and various fixed income instruments, I think, serve a great purpose, and I think that they continue to bring a level of stability. But this is a challenging time for an income-seeking investor, because you're not necessarily getting a lot of income. We're starting to see a little bit of a rise in yields, and eventually that will materialize into income. But the rise in yields brings the prices down. And if somebody's really conservative, I think that it's concerning to see potential bond prices drop. And then they start thinking, all right, where can I get that yield? Where can I get that growth? And they might find themselves further into stocks or further out seeking riskier bonds than they might have otherwise. So I do think that this has the potential to be a challenging environment for people that are risk adverse.
Yeah, I would agree that there's the potential for paralysis. If you're trying so much to find the next great investment idea that's going to get you 20% per year, you can be paralyzed at a time like this, not being able to find something. Or if you're trying to be conservative, you'd be paralyzed, like, when's the right time to get in? So I share that concern on people, actually on both extremes, that can be find themselves in paralysis and not stay fully invested. What about being optimistic? Is there anything that has you optimistic, despite kind of a slower start to 22?
I still continue to be optimistic, just looking around at how people are spending money and still have the desire to find ways to build different experiences, into their everyday life. I think that there is still a lot of the stimulus funds that have gone to consumer balance sheets and also corporate balance sheets, that there's still the desire, intent, and the action of spending money, which does help the economy to thrive. So that continues to keep me optimistic for at least a while here.
Yeah, I mean, this was a consumer-driven economy, a consumer-driven market pre-pandemic, and I think it continues to be that now. Like constraints, could be a challenge over the coming months, but I think that there's definitely household balance sheets are in pretty good shape right now, and if that's going to continue, then that's a pretty heartening thing, especially if it's the Procter and Gambles of the world and those more value-oriented stocks that are beneficiaries of that. We're going to be doing a deeper dive into the market conditions heading out of last year and into this year at our quarterly market update, which is going to be Friday morning, January 28th at 8:30 in the morning. I look forward to seeing all of you there. Feel free to sign up. We have our invitations out on LinkedIn, and you can sign up on mortonbrownfw.com. Till then, we will catch up with you soon.